What if I told you that Warren Buffett built his fortune not by chasing trends or taking massive risks, but by mastering a few simple, time-tested strategies? Welcome back to the channel. In today's video, we're diving into the genius of Warren Buffett's investment strategies. This is the second part of our special series where we'll uncover the principles that made Buffett a billionaire, principles you can use in your own investment journey. We'll explore his famous approach to value investing, how he finds undervalued companies, and his powerful moat strategy for protecting his investments. If you're serious about building wealth, you don't want to miss this. Be sure to like, subscribe, and hit that notification bell so you won't miss the next part of this series. Let's get started. Part 1. Value Investing. 101. Finding Undervalued Companies. Warren Buffett didn't become one of the wealthiest men in the world by following the crowd. In fact, he built his fortune by doing the exact opposite. At the core of his strategy is value investing, a method he learned from his mentor, Benjamin Graham. But what exactly is value investing? Imagine you're shopping for a car. You know what makes a car valuable: a strong engine, low mileage, a good brand reputation. But what if you found a car that met all those criteria and it was selling for half the price it was worth? You'd buy it in a heartbeat, right? Well, that's exactly how Warren Buffett thinks about stocks. Buffett looks for companies that are undervalued by the market, companies that are fundamentally strong but for whatever reason are priced lower than they should be. Maybe the market has temporarily lost faith in the company due to short-term challenges. Maybe there's a general market downturn that's pushing stock prices lower across the board. Whatever the reason, Warren sees these moments as opportunities. One of his most famous value investments was his purchase of Coca-Cola in the 1980s. At the time, Coca-Cola was facing some struggles, and its stock price reflected that. But Warren wasn't focused on the short-term issues. He saw the bigger picture. Coca-Cola was an iconic brand with a global presence, a loyal customer base, and a product that had stood the test of time. Warren recognized that the company's long-term value was far greater than what the market was pricing it at. So he bought, and bought big. Today, Coca-Cola remains one of Berkshire Hathaway's largest holdings, and Warren has made billions from that investment. The key lesson here? The market's mood swings don't change a company's intrinsic value. Warren doesn't care about the daily ups and downs of stock prices. He looks at the fundamentals. Is the company profitable? Does it have strong leadership? Is there potential for long-term growth? If the answer is yes, and the stock is trading below its intrinsic value, Warren buys. This patient, methodical approach to investing is what sets Warren apart from many others in the market. He's not trying to predict what will happen next month or even next year. He's investing in businesses he believes in for the long haul, 5, 10, or even 20 years down the line. Part 2. The Moat Strategy, Protecting His Investments. But finding undervalued companies is only half the battle. Warren also has a unique way of ensuring that the companies he invests in can withstand competition and grow over time. Enter his famous moat strategy. Picture a medieval castle. What kept enemies out? A moat, a wide, deep trench filled with water that surrounded the castle and made it difficult for attackers to get in. Warren Buffett applies this same concept to investing. He looks for companies with a strong competitive advantage, what he calls a moat, that protects them from competitors. Coca-Cola is a perfect example. Its brand is so powerful that it would be nearly impossible for a new soft drink company to dethrone it. Think about it. If you walk into a store and see Coca-Cola on the shelf next to a no-name soda for the same price, which one are you going to choose? Coca-Cola's brand loyalty is its moat. People trust the product, and that keeps competitors at bay. Another example is Apple, another company in which Warren has invested heavily in recent years. Apple's moat is built on its ecosystem. Once you buy an iPhone, you're more likely to buy an Apple Watch, use Apple Music, and store your data on iCloud. It all works seamlessly together. This interconnected ecosystem creates loyalty and makes it difficult for customers to switch to competitors, even if another company offers a cheaper product. Warren's strategy is simple. He invests in companies with strong moats because they can fend off competition and maintain profitability over the long term. The wider the moat, the safer the investment. And if a company's moat is growing, like Apple's ecosystem expanding with new products and services, that's even better. But Buffett doesn't just stop there. He also evaluates how well a company reinvests its profits. Is the company expanding its moat by innovating or acquiring new businesses? Take Amazon, for instance. While Warren was initially hesitant to invest in tech companies, he couldn't ignore the growing strength of Amazon's moat. Its dominance in e-commerce, cloud computing, and even media gave it a significant edge over competitors, prompting Warren to finally buy shares. Buffett often says that his favorite holding period is forever, and it's because of these moats. When he finds a company with a durable competitive advantage, he's content to hold on to it for decades. The moat strategy gives him the confidence that the company will continue to generate returns far into the future. Part 3. Buffett's Top 10 Rules for Smart Investing. Warren Buffett's success isn't just luck or timing, it's a set of principles that guide every decision he makes. Let's break down 10 of his most famous investment rules, which you can apply to your own portfolio. Rule number 1. Never lose money. Rule number 2. Never forget rule number 1. This might sound obvious, but Buffett's emphasis on protecting capital is what separates him from riskier investors. He's always looking for investments where the downside is limited. Invest in what you know. Warren doesn't invest in businesses he doesn't understand. This is why he avoided tech stocks for so long. He didn't feel confident in evaluating them. Instead, he sticks to industries he knows well, like consumer goods and financial services. Be fearful when others are greedy, and greedy when others are fearful. This rule is all about taking advantage of market fluctuations. When everyone else is panicking and selling, Warren sees opportunities to buy quality businesses at a fair price. Warren isn't interested in buying stocks just because they're cheap. He's looking for quality businesses with strong potential, and he's willing to pay a fair price for them. Think long-term. Buffett's investment horizon is measured in decades, not months. He looks for companies that will continue to grow over time, regardless of short-term market trends. The market is there to serve you, not instruct you. Warren sees the stock market as a tool to buy and sell businesses, not as a barometer of his success. He doesn't react to market movements. Instead, he stays focused on the underlying value of his investments. Only buy something you'd be perfectly happy to hold if the market shut down for 10 years. This rule emphasizes the importance of investing in companies with staying power, businesses you believe in for the long run. It's better to buy a great company at a fair price than a fair company at a great price. Quality is king in Warren's strategy. He would rather pay more for a great company than risk his money on a business that might not succeed. Understand the power of compound interest. Buffett's fortune is largely built on the compounding of his investments over decades. Small gains accumulate into massive returns over time, thanks to compound interest. Know when to say no. Warren is famous for his discipline. He doesn't chase every opportunity, and he's willing to walk away from deals that don't meet his strict criteria. Conclusion. Warren Buffett's investment strategies may seem simple, but they're incredibly powerful when applied with discipline. His focus on value investing, finding companies with wide moats, and following time-tested rules have allowed him to amass one of the greatest fortunes in history. So what do you think? Could you start applying Buffett's strategies to your own portfolio? Let us know in the comments, and be sure to like and subscribe for more insights into the world of investing. In the next video, we'll explore Warren Buffett's legacy, his role as a philanthropist, and the life lessons he's shared with the world. You won't want to miss it. Thanks for watching, and see you in the next video.